Okay, greetings, and thanking you in advance for your cooperation with this blended learning this week due to the Jewish New Year holiday and the forcing of missing class. We're going to pick up briefly where we last left off, and that was net capital gains, losses. This should really indicate, don't forget gains, capital gains. There's no special treatment with the C corporations. Remember, this chapter is on C corporations, and that's what we're concentrating on now. So, capital gains are what they are. Capital losses, you don't get a current deduction of any kind, and they can only go against capital gains. So, important planning for corporations is situation with capital gains and losses. We covered that. We talked about the NOL, net operating losses, the ability to forego carryback, very important not to forget that. Keep that in mind as you go forward in your career. And it can go back to and forward 20. Interesting to note, which I don't think I emphasized 100%, is that if you don't elect to forego, if you don't make this election, it must go back. And sometimes people forget that, and they think, oh, it can go forward, it doesn't have to go back. That's true, but you got to make a positive election saying that you don't want it to go back, otherwise it must go back. Whatever goes back and is unused goes forward, and that's the good news, and you got 20 years to use it up. There's a way to calculate it. Take a look at the book and some examples. I think we'll probably throw some homework problems in there to help see how it actually gets computed. And then we'll go over those if necessary and based on your ability. So you'll let me know if you're having any problems understanding how it goes back and forward, both the NOL and the capital loss. All right. Oh, well, here's an example. Maybe that'll help. Okay. XYZ has a net operating loss of $20,000 for 2015, and they had taxable income in the prior years. What options does XYZ have? And now we know it can elect to go back, or rather it could elect not to go back, otherwise it must go back. And if it doesn't use it up going back, it can go forward. So let's see what they do here. Could carry back. Well, they did it the same language that I was using somewhat incorrectly. Could carry back. It must carry back unless you forego. And let's see, they had 20 in 2015 as a loss, so if it goes back to 12, it would use up 10 of the 20, leaving 10 carrying forward to 13. Let's see what they say here. What am I missing? Oh, it's a 2015. See, you got to be careful of the years. So it's 2015. 12 is not part of the carryback. It's only these 2 years. Only these are prior to use. It's a 2015 NOL. And so it could go back here, taking up 3 left over, which would then go to 14. And that's exactly what they say. Or you could forego by making the election. The election is nothing more than language in the return saying, "Dear Mr. IRS, I elect to forego the carryback. I'm just letting you know." Charitable deductions at corporation level, different than individuals because of a concept that corporations, by and large, are bricks and mortars and boards of directors and equipment and employees, and it's not the same consciousness of an individual income tax person. It is a conglomeration of things and people, and therefore the concept of a corporation being gratuitous, that's a good word, I don't know if I'll spell it right, but we'll give it a good shot here. The concept of a corporation being truly gratuitous like an individual can be with charitable contributions, giving of their real heart, corporations are looked upon as not having a whole lot of heart, and so therefore charitable contributions are limited in the amount of their deduction. Of course, there's limitations with capital gain property and ordinary income property. You have to recognize at fair market value. This is very similar to the individual rules, and the same thing with individuals. And ordinary income property has to be recognized as ordinary income when given away. So you can't give inventory away. That's what this means. This means you just can't give inventory away and expect to get a charitable deduction for the value of the inventory. What you get is you get a charitable deduction because your cost of goods sold goes up. It's just less inventory. So that's all you get. You can't take a fair market value approach. No, not at all. No fair market value approach. It doesn't work. But but you do get, of course, a higher cost of goods sold if you give away inventory, and thus your net income is lower, which is what you would expect if you give it away, and you're allowed to give it away. You're allowed to. The concept of deducting it here in the accrual method, when approved by the board, paid within 2.5 months, I don't expect you to remember that, but I expect that what you realize from this, which I think that you'll get more of this course as well, is that the difference between cash and accrual under tax law is definitely not the same as it is under generally accepted accounting principles. So if you're going to make an equation of cash and accrual for tax, it's not the same as it is for GAAP. And what I do is I'm ever so conscious of the fact that there are so many different nuances that when I'm dealing with accrual or cash basis for tax purposes, I check all the I's and cross all the T's and make sure I'm within the rules of the tax code. So if you were looking at accruing a charitable deduction, I would be looking at the regs and the code, and I would see that it has to be approved by the board and paid within 2.5 months. Now, this is the big thing with charitable contributions. Since, as we said, contributions are not considered to be gratuitous in nature, they don't have a heart, then charitable contributions have been limited by the tax code of 10% of taxable income of the corporation before deducting these items: charitable contribution deducted, dividends received, net NOL, carrybacks, the now permanent domestic productions activity deduction, which I thought was going to get repealed, is now permanent. So much for my ability to predict tax law, and the capital loss carryback. The good news is that although you should learn this for purposes of this course, the good news is that in practice, this entire limitation is done by the computers, the software doing tax return preparation, so it gets a lot easier when you get there not to have to worry about all these differences. But it's good to know what the computer is doing, and it's good to understand that there's this 10% limitation of taxable income. Carry forward is for 5 years. That's the same as it is for individuals. So what you don't use this year, if in year one, first year, your 10% limit leaves you with a carryover, simply say carryover, then it goes forward for 5 years, and if it's used up in the 5 years, great. If it's not, then it ends. So that's the same as individuals for charitable contributions, carries 5 years. And it would be important to watch that so you don't lose the deduction within that 5-year carry forward. No carry back, only forward. This, you can now see, is going to be a not insignificant, potentially, depending on what the corporation does, book tax difference. That's what this is leading. Many of these things are telling. That's what these are all about, these nuances between tax and GAAP. This is a book tax difference between those two. And you should be able to start answering the question, is it permanent or temporary? And I think you would probably make the conclusion that it is most likely going to be temporary on the theory that it'll get used up. However, if it doesn't, then it could be permanent. So it's a question mark until we see exactly how it ends up. Because for GAAP purposes, all charitable contributions will be deducted in full in the year that they're taken, It's only on tax that we have this limitation. Now, one other thing with this area from a pragmatic standpoint, which I would say in class, and really have a lot of fun with you telling you about it, because some of these things that I tell you are the reality of what we do, which may not be in the textbook. I haven't checked our text to see if it's in there, but you can tell me if it is by sending me an email. But the reality of what we do in the real world is we try to take what is money going to a charity, and it looks like a charitable contribution because it's going to a charity, and we try to put this round peg into a square hole, so to speak, by telling our clients, well, don't just give the money to the charity because there's this 10% limitation, and maybe you'll get it, maybe you won't. And if you don't get it, it carries forward, and it's complicated. Don't do it that way. Do something different, like buy an ad in the charity's journal, or sponsor an event. Do sponsorship where the corporate name is being recognized, so that we can change the nature of what we call this expense from a charitable contribution to something else. I'd like you to think about what that is, and maybe you stop the recording to think about what that would be and see how close you might come to what it would be if we change the nature to a corporate sponsorship that's here, or a corporate ad journal where the name of the corporation shows up. And if you stop the tape, I'm now assuming you're back, and I'm going to tell you the answer. The answer is we now, with these kinds of changes in the flavor of how the contribution is made, we can call it something else that has no limitation, and that's advertising. And that's perfectly legitimate, and that's what typically happens in the real world of corporations, which is why what you'll see if you work for a corporation, you'll see that they do want to promote and support charities, but they'll do it not the way individuals do, just with a out-of-the-goodness check from their hearts, but they'll do it with an out-of-the-goodness check to a journal or a sponsorship somewhere where the name of the corporation shows up. They're not necessarily doing it because they're trying to get free advertising or advertising through the sponsorship, even though I guess it's not free. But they're doing it because they want to be able to not have to worry about this limitation on the charitable deductions. Here's an example, and we can go through and take a look at what happens. Let's see. Well, let's just go through the facts. PCC donated $700,000 of cash. Their taxable income before the charitable deduction of these items was, so they're already showing you, oops, sorry about the outside noise, they're already showing you what the taxable income limitation is by taking out the limits or the exceptions. So let's see what happens here. It's merely, let's see, there must be something going on out there that I should watch and have fun with. I think they didn't do this one adjustment, but after all the other adjustments are done, and this one's taken into account, we wind up with charitable income contribution limit modified taxable income. That's what they call it here. 10% is allowed, and so they wind up getting 10% of the charity deducted that year. And let's see, what is the taxable income? 6.3 total charitable contributions for the year. They're able to use the amount, which is 10% of this number. Remember, it's limited to 10% of the actual charitable contribution, or the 10% of the 10% of the net income, which is this number here. And so the limit is this, whatever the 10% of this amount, which takes off of here a certain amount, leaving, well, this is 10% of that number. That's what it is. This is 10% right there. And so the charitable contribution carried forward. You can figure out better than I can the math. All right, let's do the following. Let's hold here so we keep these short and sweet, and we'll have another one coming up in a little bit.